Great. Welcome to another Lunch and Learn Thursday. We have started October, and all of October we are talking about taxes. We are making it more exciting than it sounds, I promise. So stay with us this month. It's going to be a great time. So for those of you who are new here, my name is Maggie. I'm a partner at Purse Strings, and we're all about providing financial education for women. But then we have a list of top tier financial professionals who love to serve the female market, want to help you reach your goals and hit your dreams. And we call those our Purse Strings approved professionals. Pam here is one of our Purse Strings approved professionals, and she's going to be talking with us today. But before we dive into all that fun, Pam, could you get a little introduction of who you are and what you do?
Sure. Welcome, everyone. My name is Pam Friedman. I'm with Robertson Stephens Wealth Management. I have been a financial advisor for more than 10 years now, but I've been in financial services, investment banking, and teaching investment management for over 30 years. I taught investment management at the University of Texas. And for a minute there when Maggie said, we're talking about taxes all month, I thought she said we're talking about Texas all month. But I am from Texas. I live in Austin, Texas, although today I'm up here in Minneapolis, Minnesota. So if any of you guys are in Minneapolis, shout out to Minneapolis, shout out to Austin, Texas. So this is all I've ever done. I am not a CPA. I do not prepare taxes, which sort of makes me the perfect person to describe taxes for the average Jane. I am a certified financial planner. I work a lot with my clients on their taxes, and oftentimes they forget to tell their tax advisor something that's happened in their life. So I help them do that. So we are going to walk through a tax return today, which I hope you guys don't turn off the screen when we get to that part. But try to keep it on and keep your thinking caps on, and you'll learn something.
I love it. Well, we're so excited to have you here. And yes, today we're talking about taxes for the average Jane. We think it's a great way just to start off the month to get some information around taxes. We know it's kind of that thing we put out our newsletter. It's kind of that thing you don't want to do, but you have to do every year. Almost like a mammogram. You got to do it. It's not fun, but we got to go do it. So let's just make it the best it can be.
I swear it's not as bad as a mammogram.
we're already getting up there.
Okay, well, I'm gonna start with the slides then. If I can do this, we'll see how I do. I'm putting the slides up.
And while we work on that, just anyone who tunes in, if you have any questions at any point, feel free to drop them in the comments. We'll get those answered for you. And if you're watching the replay,
do I have to upload them, Maggie?
You shouldn't have to upload them.
Okay, good.
You should just have to share the screen.
I think that was just tips. Oh, let's see what I'm doing here. So go to present screen. There we go. I hit the wrong thing.
Go.
Aha, this is new for me. And I'm going to share this screen. And You're still seeing us, but eventually you're going to see some slides. Do you see some slides, Maggie? Are we good?
We do see some slides.
Aha. So let me just sort of jump right in. So we were going to talk today about how to understand a tax return and answer some of the questions that you may or may not have or may not have thought of. Of course, taxes, whatever you are on December 31st of that year is how you'll file your taxes, whether you're single at the end of the year. I work with a lot of divorce clients. I'm a certified divorce financial analyst. If you're single by the end of the year, you'll file single. If you support someone, you'll file head of household. If you are married, you'll file married or married filing jointly, which is much more, the latter of that one is much less common. So we're not going to have time to get into that. So some of the topics we'll cover as we go through the slides. Everybody gets anxious around tax time. That's kind of a general, I get anxious. I just got an email today from my tax person. It's just normal to get anxious. You want to do it right, but you also don't want to spend all your money on taxes. You have better things to spend money on in a lot of cases. So how can you make it a little bit better? Well, you can be better organized. And so we're going to talk a little bit about how to get organized for taxes and what that looks like. And at what point should you hire someone to do your taxes? I'm a fan of hiring someone no matter what. I'm not a big fan of the electronic. I think you'll miss something. I think the cost of hiring someone is offset by the ideas that they provide, so long as you provide all your information. And hopefully you'll know more things to provide by today. How much does it cost to have someone do your taxes? Well, there's a range, and it depends on the complication. Are you filing a business tax return? Are you filing an S Corp tax return for your business? Do you have a K-1 that from those returns that then go onto your personal tax return? Definitely need someone to do your taxes in that case. But even for the simplest tax returns, I think it's worthwhile having someone ask you the appropriate questions and filling out the forms that they send you, even though they look daunting, because it can save you real money and more money often than you pay that advisor. Is it bad if I get a lot of money back? Bad. It's bad or good? Good or bad? It's nothing's all good or all bad. Getting money back just means you over withheld, and sometimes that's unavoidable because of the way you filled out your form, your W-2 form with your company if you're a wage employee. You might, if you did get a lot of money back, you might want to review that form. The most often time I see is when there's double income, when both the husband and wife work. They say they're married, but your company doesn't assume that your spouse is making money a lot of cases. So are they withholding enough, too much? So you have to sort of work that out with your tax provider and say, hey, what should I be withholding every year so that either I don't have to pay or I'm having so much money tied up at the IRS and basically lending money to the federal government. You don't necessarily want to do that. And lastly, deductions. We're going to talk about the benefits and drawbacks of each of the categories. Single or head of household, those are really two categories. Married with double income, married with children. The category is really just married for either of those. Widow, if you're filing as a widow, you're normally filing single, but you also have to, if you're single by the end of the year, unless you have children, and then it would be head of household. But the year in which you become a widow gets complicated because you'll have to file a special return for the decedent. Nearing retirement, not a category, but we'll talk a little bit about when you're nearing retirement, what does it mean to file your taxes and what are you thinking about in terms of Social Security and how that may or may not be taxed. And recently divorced, which is the world I work with. What are you? If you divorce in January, you're still married for the year prior, but you will be single or head of household for the next year. Going on. So we have two different capital gains and income worlds. The capital gain world is when you sell an asset. So if I have an investment account and it has 100 shares of IBM, and IBM the stock is going up, I don't get taxed unless the company pays dividends, and then I would be taxed on the dividends. I have what's called hopefully it's going up. I have what's called unrealized gains or unrealized losses. If I sell that stock at a gain, in other words, I bought it for $20 a share, now it's $30 a share, I'll be taxed either 15% or 20% if I'm high income on those capital gains. It is all still part of your income. And then for most of your income, though, if you're a wage earner, you have marginal tax rates. So for each category of additional money you make, each bracket, you're taxed at a higher amount. So for the first 10% of your income, that's reportable taxable income, in 2021, that was 10%. Then the next part of your income was taxed at 12%, then the next at 22%, and on and on. The effective rate, which you'll see in a minute, is a weighted average of all your tax liability, your tax expense. So just take what came out on the system as your tax, divide by your taxable income, you'll get the effective tax rate. The top marginal tax rate right now is 37%. And although that's really small, you have to earn quite a bit to get to that 37% or have quite a bit of income. Something that comes up a lot in the divorce cases I work on, but for other people too, we used to have what was called a personal exemption. For each person in your household, that included your children, you had around a $4,000 deduction you could take off your taxes and off your income. Wow. That went away based on 2017 rules in 2018 went away could come back after 2025. But we no longer have that. Instead, what we have are higher standard deductions, which simplified our tax returns. It used to be that an individual would have only a $6,000 standard deduction. Now an individual has a $12,000 standard deduction, but no personal exemptions. So if there were two people, there's one person, they used to only get $6,000. If there was one person and a child, they would get $8,000 personal exemptions and $6,000 standard exemption. Now it's all in one package. Your standard deduction, $12,000 for individual. It's actually gone up. We'll talk about that in a minute. Started in 2018 as $18,000 for head of household and $24,000 for married. It's been going up with inflation. Another thing that changed in 2017 is that we don't get as much credit for our property taxes or state income taxes. It's limited to $10,000 of deductions. So that really hurt high state income taxes, or my state in Texas, people who have higher than, we don't have a state income tax in Texas, but we do have a higher than normal property tax cost. So a typical house in Austin might have an $8,000 to $12,000 property tax. So mortgage interest deductions dropped. I'm not going to get into that here. It's a little more complicated than what I into. But another thing that changed is that alimony that's paid is no longer deductible to the payer for cases in 2019 and later. And that was to simplify, because the way alimony used to work, it was deductible to the, let's say, husband, not taxable to the wife. Now it's not deductible, nor is it taxable to the wife if the agreement was written in 2019 and later.
Oh, so that one depends on when the agreement was written.
That one depends on when the agreement was written. So if you have an old agreement, you're still stuck with paying taxes. If you're the receiver of alimony, if you're paying alimony, you still get the deductibility.
Interesting.
Okay, so break in anytime, by the way. Any questions? So I love reading the IRS publications, 501, 504. It's, for most people, it's like wet socks on a long walk. But you will either file single, head of household, or married. And it depends on what you are at midnight on December 31st of that year. And then you actually pay your taxes. Most people know the next April. So for 2021, we all filed taxes April 2022. However, I see a lot of people get mad, like, why has my husband filed his taxes? He's waiting to file his taxes. What's going on? Well, he may have had a business tax return or a K-1 due from an investment waiting on that. You actually have until October 15th to file, which is why I'm worried about my taxes, because I'm a partner in a firm and we have a K-1. So my taxes are still being done. The other thing that you kind of see with these later filings, there's lots of reasons why you would file later. The most important thing, though, is all the taxes, the estimated taxes have to be paid by April 15th of the year after in which. So April 15th of 22, all your taxes that were estimated for 21 have to be paid by April 15th. If not, there could be penalties and interest owed to the IRS. They want their money, but they don't necessarily need the filing until October 15th. So there's a lot of people don't know that little fact there, but that's true. Now, let's say you're a little bit off, so you pay some penalties between April and October. Sometimes it's worth it. The rates tend to be pretty low. Penalties don't really start unless you don't file. That makes a bigger difference. That's the general rule, but there's some subtleties there. So this is the part where don't turn off your screen. We're going to walk through a tax return. The first page of your tax return, and this one was done electronically, actually, and it was a client, and she, I just redacted her information, but it was a pretty good example of what we normally see. You'll see sort of a summary page on your filing. You might even see this from your CPA. It'll talk something about an adjusted gross income. You're like, $92,000. I thought my spouse, or I thought I made more than that. Why is it only $92,000 that's adjusted gross income? I thought my pay was, my company tells me I'm being paid $120,000 a year, or $115,000 a year. That seems kind of low. We're going to talk about why. Then there's taxable income, what you actually pay taxes on. We're going to talk about the adjustments there and your total tax that is calculated. Any payments or credits, in other words, what you withheld on your payroll statement for taxes or what was withheld for you. The amount to be refunded in this case. In this case, she did over withhold and she has amount to be refunded. And then you see again that effective tax rate. That's the weighted average tax rate. Because remember, she was paying 10%, then 12%, and on and on and on. As she had more income, what's the weighted average? You just take the total tax and divide by adjusted gross income, and you would get that 14.21%. So real quickly, this is the top page of what people normally think of as the 1040. All your identifying information. In this case, she filed a single. Put all your identifying information in, nothing really special here. You would put your dependents down below. What's interesting about 2021 is they finally asked the question, did you get some cryptocurrency? Because the government in 2023 is going to start taxing or being more careful about who has cryptocurrency and any kind of virtual currency. So she had to answer that question and be truthful. I think that's what scares most people. Just tell the truth, you won't get in trouble. Okay, so this is the part that's the most important for our taxes. You'll notice that $93,000. I'm going to come back to that $93,765 and where that came from, but that's her wages, salaries, and tips. That comes from her W-2, which we're going to look at in a minute. You can also see on line 8, $12,000 loss. Well, that was a loss from a business she had. This particular person works for a university, but she had a little kind of side practice where she was doing some consulting and had some costs against that consulting. So she made some money, but it was more money than she made. And so she was able to take a loss on that activity. You'll see in lines 2, 3, 4, 5, 6, these are all different types of other income you could have, like tax-exempt interest, qualified dividends. So if she had had an individual investment account, not a retirement account, she might have reported some interest dividends on those lines. You can see on 4A, if she withdrew from her IRA. In 5A, if some movement happened with some pensions or she had some pension income. 6A, Social Security benefits would be reported there. What a lot of people don't know is that Social Security benefits, up to 85% of your benefits could be taxed if your overall income is more than $35,000 to $45,000, and there's different rules every year. But at pretty low income levels, your total income, Social Security benefits are taxed. If you are not full retirement age, and that's a definition under Social Security, but around 67, and you work while you're taking early Social Security benefits, that can really be a bigger tax. They don't like you doing that, working and then taking early benefits. So anybody wants to call me about that later, we can have a whole conversation about that. But I want to go back to this $93,000, which I think is, and this won't quite match up because I don't have her W-2, but this is an example of a W-2. And where they're grabbing the income from is right here. It doesn't quite match up. It doesn't match up because I don't have her particular W-2. This is just an example, but you'll notice that she looks like she paid Social Security and Medicare taxes on a bigger amount. Your wages are reduced by box 12. The D is her 401k contribution. The double D is $1,000, and that is her what she contributed to medical expenses. That gets taken off of your federal wages, and you're taxed actually on this. These are before tax, so even though you earn them. Actually, not her medical in this case, but in this, is that right? No, just her 401k contribution, not her medical. So Social Security is actually paid on your full gross income. And Medicare is paid on your full gross income. Social Security is together they're 7.65% of your income.
Wow.
If you're self-employed, you pay twice that, but you get to deduct 1/2 of it, which we can't get into self-employed just yet. But that's high. On your Social Security, it's only paid on your first $147,000 of income. That number goes up every year. Your Medicare is paid all the time. So Social Security is 6.2 of that 7.65. Medicare is 1.45. I think if I'm doing it right, no, yes, 1.45 of that, of all your income. There's no income limit. Social Security is only on the first 147,000 of income. That comes into play in divorce for, spouses who have lots of income, who's paying what. So let's get back to this. So that's how we got, it was from box 1 that this number comes from.
So that was from the form that your employer sent you, because I know we're always waiting in the mail.
Yes, this usually arrives sometime around the end of January, maybe beginning if they're getting faster with it, but usually get a form. Down here, there's some state taxes. We don't have state taxes, and and I forget what P is. But if you're interested in some of these codes, you can just look up W-2 codes on the internet, and you'll figure out what all the codes are. Lots of things are reported here, like stock options, and you may want to know more about that. But we don't have a lot of time, so we'll just get to it. She actually took more than the standard deduction. The standard deduction for 2021 was $12,550 for a single person. She itemized her deductions. She had more than that, and we're going to talk about what itemizing your deduction means. Then, of course, you take all this together and subtract what you need to subtract, and we came up with her taxable income, and that's at the bottom of page 1 of your tax return. I'm going to skip ahead here. That gets carried over to page, whoops, what got carried over to page 2? There we go, blah. I think I copied some stuff. There's her tax, what her tax would actually be calculated. Then we're going to look at adjustments. All these are adjustments, which we don't have time to get into, but this is her actual taxable income. This is her tax. It looks like the same number, but it's not because it just happens to be $13,000, but this is her actual tax. She withheld on her W-2 $14,830. That'd be equivalent to whatever's in this box. In this case, it was only $6,000. They put that in. It turns out she paid more than she owed in tax, so she got a refund. And the refund is on line 34. Sometimes people carry that forward to 2022 and say, just use that against my taxes next year. And some people say, send me a check. Most people say, send me a check. So there'll be a routing number and account number you can put on your tax return, tell them it's a checking account, and they will send that directly to your checking account. So that's the quick about all of that. So I thought I'd leave. I can't believe I did that in 20 minutes.
It was impressive.
I'll put a little, if anybody wants to take a quick picture of how to get a hold of me, you can always get a hold of me through Purse Strings. I'm on there and happy to be a member of Purse Strings and one of the providers that have been qualified on their system. And just because my compliance group will complain, here's our disclaimer. So it just says we offer advisory services, and that this is in no means tax advice, because it's way too trying to cover things too quickly, but I'm always glad to talk about it. I do have a Calendly link if you'd ever want to spend a half an hour with me just to chat. It's there. It's Pam-Friedman, spelled like Friedman. Right there in the middle. That's the best way to book a meeting with me. So I'm going to close this now and come back to the actual screen, which hopefully I can see. I don't know what happened there, but there we are.
Awesome.
And I'm happy to take a quick question.
There's a lot of great information.
We only have a half an hour, right?
Yeah.
Okay. So I was trying to squeeze a lot in there to talk about taxes for the average Jane. And shout out to my client who allowed us to use her tax return anonymously. But I didn't get back to that itemized tax. So either you take the standard deduction, $12,550. Itemized deductions, you would add up medical cost in excess of 7.5% of your income. So it has to be more than 7.5%, the part that's more than 7. So if you had excessive medical expenses, normally what we think of as itemized deductions is the interest on your mortgage, as well as up to $10,000 of your property taxes and state taxes. Also, charitable giving count as itemized deductions. Those are the major categories on the itemized deductions. So keep that in mind. Add those all up. If it's more than the standard deduction, you'll want to itemize. So you should become familiar with the itemized portion of the tax return and make sure that you're providing to your tax preparer, or CPA, all the information that might be related to those sections so that you get a bigger deduction, which will save you on taxes.
So part of that would be like, I know, I'll go to the Goodwill or the Salvation Army and drop off a bunch of things, and they're like, oh, do you want this piece of paper? Which would be like, you can itemize on there what you donated, and that with the medical expenses and the homeowners taxes.
Interest, yeah, your mortgage interest. You'll get a 1099 form from your mortgage lender also in January, February. You'll get a 1099 also from any investments that you have. If they're non-retirement accounts, retirement accounts don't generate income unless you withdraw from them. So it would be from an individual brokerage account. You might get something from your bank that shows interest earned. Highly recommending that people get a little more interest from their bank account these days by using some of these online companies like Ally or Marcus for their savings and get a little interest, but the interest is taxed. So just don't forget, you have to report that as well.
So be all of that added up.
All that still counts as, what I do is when I start getting all those documents in January and February, I put them in one single drawer. I say, I can't deal with this right now, but I'm going to put it all in the same drawer. Everything goes in the same drawer that I get in the mail. And then go through it, scan it all in for my tax provider. So it's try to keep as organized as possible. As your life becomes more complicated, you might want even a personal bookkeeper, but if your life is fairly simple, a drawer kind of works pretty good.
I love that. Ton of great information here. And so, people wanted to take it doesn't seem like that you really need to take any actionable step today, because we're just kind of in the middle period right now. We're waiting for the next year to kind of come around. And so maybe something that you would want to do is just find the tax person you might want to work with next year.
That's a great idea. And also, be tracking your medical costs. Everyone go online now and see what they're paying interest on their mortgage. Make sure you can get online to all your financial institutions, your bank. If you have an investment company like Schwab or Fidelity, if you have anything that you can get online to, make sure you're getting online and kind of keeping track of what is there. Medical is often the hardest. So if it does happen to be a big medical year for you, take the time now so you don't get stressed in January and February to add up all those out-of-pocket costs, whatever you've had to pay that was outside of insurance. If you're self-employed, you want to add up what you paid for insurance because that can matter. So,
that's a good tip to know.
One of the biggest places you can save is many people don't realize they did 10 different things medically in 1 year. They did their colonoscopy and they broke a leg and they did all these things, and it really does add up to more than 7.5% of their income, their taxable income. So be careful with that. And then if you're taking Social Security or transitioning Medicare, Social Security age 65, 67. Make sure you have all those documents and that you can log on where you need to be able to log on.
It seems like, those are some of the best tips to, be less anxious around tax time, is just kind of make sure you can log in, who you're going to be working with. You're keeping kind of track today of those medical expenses, knowing where things are, just kind of being on top of it, which we recommend kind of all the time as well, just so you know what's going on out there. And then, like I said, like you mentioned at the beginning, having someone do your taxes is, always, it depends. Do you know, as a ballpark, is it like 200, 2,000, 20,000? Like how much?
Right. I think right now, anywhere between 400 and 750 is sort of normal.
Awesome.
Across the country might be, differences in who you hire and what kind of work they're doing for you. If you have rental real estate, if you have a S Corp, if you're doing you're self-employed, tends to be on the higher end. Lower end if you have a pretty simple wage. But I do think that taxes, while they tried to simplify them back in 2017, they still have some tips and tricks. And so I feel like the cost of a tax advisor or tax preparer is often worth it. They'll find something that saves you that cost in the process. I can't promise that they would, but that's my thought on hiring a professional to do it for you.
Definitely. And yeah, sometimes it's just nice to know kind of what that number is, like ish. So we can plan for it or plan around it. And
I don't mean to interrupt, but a lot of self-employed people, especially like therapists and people who maybe do this on their own, sometimes an S corp, making the effort to become an S corp, can really be a tax saver. And so having that discussion with a tax planner can be eye-opening. And would you rather pay the planner, pay taxes? Well, if the planner's less expensive, I'd rather pay the planner than the taxes that I would save. So
definitely. And that's the thing, is we don't know always what we don't know. And we're a professional at, therapy. We're not the professional in taxes. So let's let everyone do their expertise. But I think this was a ton of great information, Pam. So I appreciate you just kind of breaking it down for the average Jane out there and understanding a bit about taxes. I know you put your link up before, and we've had your email going down at the bottom here. Pam's also a Purse Strings approved professional, so you can check her out on our site, pursestrings.co.
Definitely do that.
Are there any last tips, tricks, pieces of advice you wanted to make sure got mentioned today?
I tried to cram in as many as possible.
I know. It was great information. Don't get me wrong.
Once October 15th is over, it's a good time to visit with a tax planner before they get busy again in March. Really by mid-February, they're busy again. So now, if you're going to meet somebody or find somebody in your market, get advice from friends, look them up online, make sure they're qualified.
Go to Purse Strings.
Look them up on Purse Strings. Friends are a good place to start. Purse Strings is a great place to be and to find professionals, and do it, between October 15th and February 15th, rather than trying to rush it right when you're thinking, oh, maybe I should get a professional. Don't plan ahead. There's my advice.
Finding your primary care physician before you're sick.
Yeah.
You just want to know who they are, know who you're going to go to.
I'm kind of bad about that. I'm good about my numbers, but not necessarily.
We're not health people, so that's fine. Well, I appreciate everyone tuning in today or watching the replay. We'll be here all month talking about taxes. It's going to be so fun and exciting. We're so glad
I'm impressed that you all are here. Yay!
Yay! Round of applause for everyone who's joined us and stuck with us. So thank you, Pam, and we'll be back here again next Thursday. So talk to everyone soon. Bye.
Yay. Bye, guys.